Hello and welcome back to the complete day trading course by Wealthy Education. In this video, we'll take a look at how to trade broadening tops and bottoms in the first video here of Module 3. A broadening top or bottom is simply the market broadening its range over time. And what I mean by that is that price will just simply get wilder and wilder and wilder, using a couple of trend lines that are getting wider and wider. And a broadening top, as you suspect, is at the top of a move higher, and this means typically bearish things. A broadening bottom, which is a little more rare, is at the bottom, and a breakout normally means positive things. Now, some of the patterns that you'll learn in this module have built-in measuring sticks of where you're going to end up. These patterns don't necessarily, they just signal a potential trend change. So what we see in this type of pattern is there's a lot of certainty, like over here, there's a lot of certainty in the upside, and then things just get wilder and wilder, and as less certainty comes into the market, people who are hanging on want to take their profits. And once we break through this trend line, then it shows that it's really getting ugly out there and we sell off. Now, some people will try to trade for the length of the pattern. That to me, historically is a bit difficult. Some people will try to trade for the middle part. As a general rule, the best way that I have found to trade these is to simply take the break, look for the next support, or in this case, resistance level. So over here on Visa, you can see that we had been rallying for some time, and then the market really started to get volatile and choppy. And then once we broke through this downtrend, the supportive downtrending line, you can see that we really unwound. And in fact, we ended up taking out most of this move eventually. And I would also point out that this line extends out to be resistance later. Pretty easy thing to grasp because the market had been reliable. Now all of a sudden it isn't. So at first glance, you may not see it in this, but Apple has one over here as well. It's a huge one. And you can see that we really started to widen out after dropping. And this shows that, we try to rally and then there's even more confusion and then we break out. Now, this is one of those scenarios where you could have traded the beginning of the cone, the megaphone, if you will. And sometimes you'll hear it be called a megaphone pattern. Same thing. And that would have reaped benefits. This was such a huge level, though. This was literally like $18. So that's a massive target. You're never going to get that during a day trade anyways. Or I should say you very rarely will get that type of move. But as you can see clearly, we were selling off and people became less and less confident of that bearish position. And eventually we took off to the upside. Hello and welcome back to the complete day trading course by Wealthy Education. In this video, we're taking a look at triangles and wedges. Well, let's first define what they are. A triangle is exactly what it sounds like. It is a triangle shape or pattern. So what you get is you get the markets bouncing back and forth in an ascending and descending trend line. And eventually you get a breakout. Now, this is a symmetrical triangle, which means it's an even fight, if you will. And then eventually, once you get the breakout or the breakdown, you follow. There is an ascending triangle, which shows more buying pressure because they're buying at higher levels. And then there is the descending triangle, which shows that sellers are coming in a little bit more aggressively. The beauty of these triangles is that they have a measuring stick. It's basically the height of the stick or the triangle. So in this case, you would aim for that much. So say it's $1, you aim for $1. $1 here, $1 in either direction here if it's all the same height. Wedges aren't quite triangles but they are a tightening of the market. So a wedge might look something like that. Market's banging around on the inside. They tend to break in the opposite direction, so it's an ascending wedge. You're looking for a breakdown or a breakout on a descending wedge. You aim for the bottom of the wedge. In both instances, you put your stop loss on the other side of the pattern. So with that, let's take a look at some charts and see what we can find. I see one immediately here on Citi 30-minute chart. You can see that there was support there previously. We break to the upside. The height of this is basically $1. It's like $1.02. And you can see we hit that almost immediately at the breakout point. So you measure it from there. Stop would have gone on the other side of the triangle. As I go looking for other patterns, keep in mind that this is on the fly. So this shows you just how common they are. Here's a wedge, an ascending wedge. We broke down through there. We not only hit our target, but we went much lower, obviously. And in fact, there was another wedge here, which we also hit our target. Here's an ascending triangle. And it comes down to whether or not you count wicks on this one, because we didn't close below there. So that comes down to your aggressive or risk appetite, if you're aggressive or not. You can make a case for a wedge there. We hit and then turned around and formed this triangle. I mean, that's how often they happen. Let's go ahead and take a look at, say, JP Morgan, 30-minute chart as well. I'm sure I can find plenty on this if I spend a few minutes. So I could make a case for a descending wedge there, which did in fact hit the top. There's definitely one there. So there are a couple of filters that you can use. One thing that a lot of people like to do, and this is especially true with triangles, and it doesn't matter the triangle, but they want to see at least 20% to the apex still unfilled when we break out. Because what can happen is you can go through the triangle and simply go sideways. That does happen. But as a general rule, this is a filter that some people will use. Wedges, people don't tend to be as picky on, just because by their very nature, they don't have a complete apex. It does help if it goes with the overall trend. But another thing that you may want to keep an eye on is occasionally you will see a triangle that doesn't work out. In other words, like an ascending or a descending triangle that fails. It goes in the other direction. Well, quite often that's either reversal of the trend, longer term, short term, depending on the chart, but it shows you that something has fundamentally changed with the attitude of the market. So keep an eye out for that. That's a little bit more advanced and convoluted, so I won't go into it here, but it is certainly something that you will notice over time that, sometimes they don't work. You've got a perfect descending triangle, for example, and then you break to the upside. Well, a lot of times traders would treat that as a wedge. In other words, they try to take out the top or try to trade to the top. Looking at this, I see a argument for a nice triangle here. Again, the wick did dip down below, but we have the triangle left. We broke to the upside. We hit there. So even if you were trading this as a wedge, which you could make an argument for that as well, either way, your target was hit. The height would have been about $3. So from 104 to 107 is what we're looking for. So right there would have been your target either way. And of course, there was resistance in this messy trading over here. So there's a lot of different reasons and a lot of different ways to trade these. But as you can see, the one common theme is it gives you a nice measuring stick. It tells you where the market, quote unquote, should go. And the great thing about that is a lot of traders use this methodology. And in fact, there are traders out there who trade nothing but triangles and wedges. So that is a consolidation pattern that is quite common. A lot of traders use it. It's very easy to use, very easy to spot. Like with all things technical analysis, the higher the time frame, the little bit more reliable it's going to be. But clearly, this is a well-studied and time-tested pattern that people use over and over again. And I invite you to look at any chart, any time frame. You will see these occur time and time again. Hello and welcome back to the Complete Day Trading course by Wealthy Education. In this video, we're taking a look at flags and pennants. So let's start by defining a flag and a pennant. And they're both consolidation patterns at the end of a long move. So for example, you will have the market going higher or lower because there is an inverse as well. So you have a trend going higher, and then what happens is you run out of a bit of momentum, and then you fall or you rise, and this is a flag. Now, the thing about a flag is it has a little bit of a pullback. So the market goes this way and then does this. And it winds up and it pulls back just a little bit. And on a break of the flag, it should continue. Now it's the same thing over here. We go lower and then we bounce, we pull back a little bit and then eventually break down. So how do we trade this? Well, the flag's very easy to trade because you take a break of the uptrend line. You put a stop loss either on the other side of the flag or in the middle of it. It just kind of depends on your risk appetite. And then from here, you extrapolate the pull of the flag. So the pull is what the initial move was. So say this is, let's just say, for argument's sake, this is $3. Well, on the break of this, you're looking for $3 from the breakout point. Not from here, but from the breakout point. Same thing over here. If this fall and this pull here was $1, once we break down, you're looking for a move of $1. So that's a flag. Pennant is the exact same thing, but with one caveat. So you've got your bullish and bearish pennants, but it comes down to the consolidation at the end of the pull. Doesn't necessarily have to pull back a little bit. A lot of times it will, but it doesn't necessarily. So sometimes you'll see it like this. Looks like a pennant flying in the wind. Same principles apply here, though. Stop loss on the other side of the pennant. Take your measured move. If this is $1, then you want $1 on the breakout, and so on. So it is the same it's the same technical setup. It just refers to the consolidation area where price gets stuck before taking off. So let's take a look at a couple of examples. I've got a couple of bearish examples ready for you on the charts. In this case here, this is Apple 5-minute chart. You can see that we broke down and we pulled back a little bit. You can see that there was a clear channel that we were pulling back. This bearish flag represents a potential move of, let's see, this is 186 and this is 183, so $3. So a move from 183.50 down to 180.50 would be the target, which is basically right about where we bottomed out. Now, that's a pretty clean example. There are, other messier bits, but the idea of a flag is you want it to be as obvious as possible because you do want other people jumping in. The more obvious a flag is, the more people are going to say, hey, I want to trade that. Then it works in your favor. So here is a little messier pennant. Go ahead and draw this out here. So there's your pull. There is your pennant. Oops. I guess the pull is more like that. And you can see that it measures for a move from 117 down to 115, so that's $2. On a break below, you expect a move of about $2, so right around 113, and that's where we stopped the next day, and then gapped a little lower and continued to go lower than that. Pennants, typically, I would say, and as a general rule of thumb, the flag is a little bit more reliable only because it's so much more obvious. With all technical analysis tools, it works better on the higher time frames, but 5-minute charts work as well. I just showed you a couple of examples. Just keep in mind that your risk appetite determines the stop loss. So, for example, if you are shorting a bearish flag on a breakout, you can put the stop up here or in the middle. It doesn't really matter. It comes down to how comfortable you are. And a lot of times what I'll do is, so if this is $3 and the aim is $3, I'll go ahead and take like profits at $2.85. There's no need to miss by a tick or two and then have it go back against you. So I try to take most of the move. I might be risking, say, 20 cents here, aiming for $2.85. Nice, simple play. Flags are traded all the time. And again, the more obvious, the better. Hello and welcome back to the complete day trading course by Wealthy Education. In this video, we'll take a look at trading gaps. Now, a gap is just simply what it sounds like. It's a gap at the opening of the session, and it's just an area where no trading was done. So, for example, I'll go ahead and zoom in on this particular gap here. We closed at the end of the 8th here in Walmart at 94.69. We opened at 94.64. So typically what you want to see on a gap is a clearance, a complete gap. It's not a partial gap. It's not like it opens up here. It's a full gap up. Otherwise, that type of gap, that although it gaps higher than the ending price of the candle from the previous day, it's pretty minor. So you want to see clearance there. And you got that. This was a pretty big open change. A lot of times these will happen with earnings, but they happen all the time anyway. So you can look at it as an actual trading strategy. So a lot of times what traders will do is they will do a handful of different things. They will enter right at the open and put a stop underneath the candle that gapped up from. It's kind of a wide stop, but this is a 15-minute chart. It's definitely doable, and you definitely made your money. Sometimes traders will try to buy right about halfway, filling the gap. Same stop loss placement, same theory. The one thing that you don't want to do, and we see a lot of retail traders that are new do this. Say you close here, you open here. Well, there's an old expression that gaps get filled, and typically that's true, but it doesn't happen that day necessarily. So unfortunately, some newer traders will try to short this gap with the idea of it's going to close. And you can see it worked for a little bit in this example, but most decidedly went against you in the end. So, like I said, gaps are things that happen all the time. This is a gap that came back about halfway and then rallied, and then even came back the next day at the open. It gapped right back down to that gap and then shot up like a rocket. Gaps aren't 100%. Here's a nice gap up that just never worked out. And that brings up the next bit. There are gaps down. You can see that we started there. We pulled back about halfway and then sold off pretty drastically. So the couple things that you might want to think about. Gaps are very volatile events, so I certainly wouldn't risk a lot on a gap, maybe 1% of your account tops. They are reasonably reliable, though. But unfortunately, when you're wrong, you're going to be horrifically wrong, it seems. That's just an observation. There's no statistics behind that, but it just seems as if when gaps fail, they fail spectacularly. So what you want to do when it comes to gap trading is follow all of those rules that I suggested, but you also want to keep in mind that there are larger support and resistance levels at play. So I will go back to the daily chart. And you can see that there are gaps on the daily chart as well. I mean, they obviously will show up there. So for this gap down, we pulled back about halfway, and then we broke back down to this area. Now, we did break higher, but there's a couple things that I would point out. While this trade could have worked, selling here, taking your profit at the bottom of the candle, the most important thing to pay attention to on the daily chart is that we are in a big uptrend. So because of that, this gap isn't as appealing. Yes, it could be the beginning of a major downtrend, but it's easier to follow the overall trend. That's a theme that I keep pounding in your head, and with good reason. You can see that this is an area that had been resistance previously. It should be support, and lo and behold, that's exactly what it was. So the fact that we bounced from there shouldn't be much of a surprise. Now, alternately, as I continue to go lower, we have a gap higher in what has been a move higher for some time. And that is a little bit easier to trade. And where did we end up? We ended up right here, an area that was previous resistance. So that makes quite a bit of sense. Beyond that, the gap was pretty remarkable because we had this inverted hammer and then just gapped up massively from there. So that is a double bullish sign because this shows that the sellers just couldn't hang on to bearish pressure. That is a perfect type of gap to play. Now, as a day trader, you probably were out at the end of the day, but that makes sense. You can see that this works on all time frames. It doesn't matter if you're a day trader or not, but this gives you a sense as to how you should look at this. You say, okay, well, what's the trend? The trend's up. So in Walmart, we would be looking at gaps higher. Gaps lower, we won't trust as much. Now, granted, this was way back here that I was looking at, but you can see that clearly they have worked over time as I get closer and down into the uptrend. So gaps are very important, but follow the trend. Don't try to get too cute with them because they are much more believable if the market is already bullish of a story for a company. And then we get some type of confirmation or some type of event that makes people even more bullish and more money comes flowing into the marketplace. Hello and welcome back to the complete day trading course by Wealthy Education. In this video, we'll take a look at double tops and bottoms. A double top or a double bottom is exactly what it sounds like. It is where price reaches, in the case of a double top, two areas or two times the same area. It's a top of the market, if you will, and a double bottom is, well, the exact opposite. They're pretty easy to trade, actually. There are a multitude of ways that you can approach it, but the most conservative way is to wait until you have not only the potential double bottom, but you break above what would be the middle part of what eventually becomes a W or an M pattern. So basically you need, in the case of a double bottom, a low, a lower high, a similar low, same price basically, and then a higher high. So it shows a bit of a reversal. Pretty straightforward to trade, very powerful, especially when you talk about trending markets. So for example, I've got Amazon in front of you. This is a market that has clearly shown a bit of resistance here, and we have a little bit of a double top here. You could play this out like this. So at this point, what do? Well, you short on a break of what would be the bottom of the M, the middle part of the M pattern, and you aim for the next support or resistance, which is right here. 1910, and you can see that worked out quite nicely. That was a very negative day and we rolled over. There's one here. Now, there is a wick that comes down lower, but most people look at these in the candle body themselves. So where do we go? We go right to where that resistance is. pretty straightforward. So not a huge trade, but a nice one. Keep in mind that this is a 15-minute chart. Where do you put the stops? Well, the stops are pretty straightforward. You just put them above the double top or below the double bottom. Are they reliable? Yes, they're pretty reliable. I mean, nothing's 100%. The higher the time frame, of course, the more important they are. If they go with the trend, meaning if we get a situation where we're in an uptrend and then we get a pullback, they tend to be more reliable. So by virtue of the way Amazon has traded for, as long as I can remember, at least, it's been in an uptrend. So by virtue of that, double bottoms have worked out quite well. Here in the Citigroup stock, you can see that we've been pretty negative for some time. So this isn't technically a double top because they are spaced out a little bit too far. And don't get too hung up on the idea of the exact tick. If they're a few cents apart, the tops or the bottoms, it's not that big of a deal. So, for example, I would consider this a double top. I would consider that your breakout point, and you can see that we ended up filling all the way down to that gap 2 days later. Most of the day you would have been selling off as well. Double top there, right down to the resistance. Double bottom, rallied quite nicely. Sometimes, if you don't really have a target, let's just say you don't up here, you can take the size of the pattern itself, extrapolate that. So 1 for 1, just like you would with like a rectangle or something like that. If this is $10, for example, then your target is $10 on a breakout. It's treated the same way. So in this trade, you'd be long here. You would be aiming for about, I'm going to eyeball this and say 60 cents. You would have stop loss here. And then that would be 60 cents. So you're looking at 72.60, which is right there, which is basically right where it stopped. Pretty straightforward way to trade. Very common. No magic to it whatsoever. It's just an area where price can't either go above or below. So simply trade where the market doesn't want to be. That's the idea of a double bottom or a double top. Hello and welcome back to the complete day trading course by Wealthy Education. In this video, we'll take a look at how to trade rounding tops and bottoms. Let's go ahead and define that first. A rounding top or a rounding bottom is simply price action that moves like this. And the idea is, in the case of a rounding bottom, you have a market that's going lower and then it just kind of gradually turns to the upside. And the reason that this is important is because it's not sudden. It's a longer term kind of shift in perception of value, if you will. And then what you're looking for is the beginning of the latest dip and then a break above it. But you don't want it sharp. That's a reversal pattern. This is more like turning a large ship. This is, in theory, going to be more of a sustainable trend change. Whether that's true or not is up for debate. But and as a day trader, you're looking at this as short term anyway. But most times when you hear rounded top or rounded bottom, you'll hear it applied to like weekly charts, like it would be a complete change of thought. But on the short term charts, we can apply this principle as well. So I have a rounding top here after a nice rally. So how do we trade it? Well, a rounded top shows that we are starting to fall back down. We're losing momentum. We identify where the rounded pattern is. We put a stop loss somewhere above it. And then on a break below that level, you try to extrapolate the same distance. So, and in this case, if it's $1, you're aiming for $1 below. You can see that this area here is almost like a neckline with a head and shoulders pattern that you may be familiar with. If not, we have that video coming up. And this is basically your trigger point. So in this case, this is a rounding top. And you can see that we have broken through the bottom of it. You can make an argument for about 40 cents. So that should be about 14.20. That's exactly where we went. And you can see that it's a 1-to-1 trade. You can also use them for longer trades for the rest of the day. So if you get a rounding bottom at a major support level, for example, you could really see a change in attitude. There's a rounding top there, rounding bottom there, which reached, just barely reached, and then we collapsed. There's a nice rounding bottom because you can see that it takes its time. So once we break above that, that's a signal that we should get that 40 cents or so, and that's exactly what we get right away. Now, with all things, okay, this is JP Morgan. Let's go ahead and pull up the daily chart. Now, with all things trading, you want to follow the overall attitude of the market. Now, something that I would point out is that where the market is as I record this is, near a pretty significant support level. So keeping that in mind, you look at the trading action, there's a little bit of a V bottom. This isn't quite a rounded bottom, but if it does kind of round itself out, then that might be a reasonable trade to take because you're lining up with the longer term support and resistance. In this downtrend that we had seen on the 15-minute chart, and certainly the market had been selling off, you can see we have a rounded top, and we most certainly got our profits there. They're very reliable patterns once you get that break. Trying to anticipate them, on the other hand, could get you caught in consolidation and get you trapped in the wrong position. So keep that in mind. It's not something you want to anticipate. And, quite frankly, you shouldn't be anticipating anything. You should be reacting. That's where a lot of traders get into trouble. So here's an area that we have obvious consolidation and a couple of rounding tops and bottoms appearing. They're not as easy to trade in this scenario because we're so tight. But you can see that they did work out several times, time and time again. And think about what's going on. So in a rounding top, and that's the opposite in a rounding bottom, you have buyers getting involved, but gradually the market just isn't moving in their direction. It's not necessarily a panic. It's just you're not making any money and you're tired of this dead money sitting there. You might be down, 15 cents. From here, for example. Well, once it gets to be 20, 25, 30, you start to see the momentum pick up. It's more or less just and I hate to use the phrase longer term, but it's a relative term in this case. But it's like a longer term perception that, maybe this stock isn't going where we think it is. And therefore, in order to get out of a losing position, the buyers have to sell or the sellers have to buy, and that completes the reversal pattern. Hello and welcome back to the complete day trading course by Wealthy Education. In this video, we'll take a look at diamond tops and bottoms. Diamond tops and bottoms refer to support and resistance levels in a chart, at the top obviously being the top of the market, bottom being the bottom. And what happens is you get markets that go and they find support and resistance, a downtrending support line, and a broadening pattern, if you will, and then a shrinking pattern. And then eventually, in the case of a top, it breaks down. Diamond top. So you can literally draw 4 support and resistance trend lines. Now, in the bottom, it's the exact opposite. You have price drifting lower, and then it broadens a bit, and then it tightens, and then it breaks out to the upside. Now, why is this significant? Really, what you should be paying attention to here is that the market is widening, and then it's tightening. That means it's coiling up like a spring. That's really the most important part about this. It's not the diamond shape itself. So, looking at this tells you that you are going, in the case of a top, you're going higher, and then the market's getting more and more volatile. There's a lot of indecision, and then everybody kind of calms down, and then we break down because we are concerned, and then suddenly something changes. It is a pattern that has a measured stick built into it. It's a little bit of a subjective pattern, so I invite you to experiment as to whether or not you can find them cleanly. Not everybody can, but in this case, we have a diamond pattern at the top of a move higher. You can see that there is a support line and a resistance line that are widening and then do the opposite after a huge and substantial move to the upside. On the breakout point, what are we looking at here? Well, what we're looking at is a move that projects to the same distance of the diamond itself. And you can see that clearly that's exactly where we got. Now, it did take the second day of trading into this pattern to hit that target, but you would have certainly gotten close enough by the end of the first day. Also, I would point out that the stop loss is pretty easy to do because either the pattern works or it doesn't. So you just put it on the top of the candlestick inside the triangle that led to the sell-off. That way you can mitigate your risk. Now, again, the one downside to these things is that they are a bit subjective, and a lot of technical traders don't like that. But they happen enough that they are worth paying attention to. But again, you can make an argument for a lot of diamonds in a lot of different places. Unfortunately, all it takes is being creative with trend lines. So what I suggest is focus more on the fact that you're in a trend and then things broaden and then they tighten. And then there's a move. That's really what you need to be paying attention to, as opposed to whether the lines are perfect diamond. Like I said, it's kind of a subjective pattern, but it is a pattern you hear about. A lot of times, like ultra short-term traders will look at them. And then you're talking about much smaller moves. But they do work in that sense, just because volatility starts to get wild and then it disappears and then it explodes to the upside again. But as you can see here, I can make an argument for a diamond pattern here, even though, a lot of people could argue against it, and that's where you run into trouble with this particular pattern. But there is a diamond pattern there, as shown by these trend lines, and it does, in fact, reach the target. So read into it what you will. Another thing that you should probably pay attention to, like in this case, we've rallied significantly. The market looks a bit confused, and the market will naturally pull back a bit anyway. So that's another way to look at it. It does tend to be a little bit more helpful on the very short-term chart. So this is a 3-minute chart, for example. Hello and welcome back to the Complete Day Trading course by Wealthy Education. In this video, we're going to talk about the cup and handle pattern. The cup and handle pattern is a bottoming pattern or a topping pattern. If you get the inverted version, you almost always hear people refer to the bottoming pattern though. And essentially what it is markets doing this and then pulling back a little bit and then taking off. The idea is it's supposed to be like a teacup. And what happens is price kind of drifts sideways or does very little, and then it takes off a little bit, pulls back, and then it breaks out. So the downtrend comes like this. Now an uptrend and an inverted cup and with handle looks more like this. Same scenario though. So how do we trade it? Well, we trade it on a break above the handle. We measure the move, the height of the cup, and then we just extrapolate it out. So that's your target. I have a pretty straightforward example here in the Disney 5-minute chart. Most of the time when you hear cup with handle though, you're talking about like a daily chart. This is more of a longer term trader's technical analysis tool, but it does work on short-term charts. You can see that we had bottomed here and we tried to form a cup with handle, just couldn't quite break out. we did it again and then finally did. So at this point, you have a target. You have 114.80 and 115, say 50. So that gives you about 70 cents. So 115.60 would be your price, roughly. Then you've got 16.30, which would be your target. And that's exactly where you started the very next day. Now, if you're a day trader, you're probably out at the end of the day, knowing that, you didn't get the last little bit, but clearly you've had a nice move. Couple with handle is a pattern that can be a bit tricky. Basically, the most important thing is you notice that it's like a rounding bottom or a rounding top, and then you get a pullback and then an increase in pressure. It's very similar to a rounded top or bottom. It just has this little bit of a handle where really it almost is like a curved pole with a flag. But nonetheless, it all says the same thing. It says that we are grinding higher and then suddenly picking up speed, which of course is a very bullish sign. Remember to trade the width. As far as stop losses are concerned, a lot of times what you'll do is just put it behind the handle. So in this case, you would have gotten in, say, at 115.60. You would have risked about 20 cents or so, aiming for the larger move of about 70 cents, 80 cents based upon this. Pretty straightforward pattern, very useful. Higher time frames, of course, work better. And it takes so much time that a lot of times short-term traders completely ignore this one, which, is done at their own peril because it clearly does work. It's a pretty well-known pattern. But again, it tends to be more long-term analysis, but you can also use that from your daily setups. You look on a daily chart, you see a cup with handle getting ready to fire off. You put that in the back of your mind, you put it in an order, and you follow right along. So either way, you can use it. Hello and welcome back to the Complete Day Trading course by Wealthy Education. This is how to trade head and shoulders. So I'll go ahead and define a head and shoulders pattern first. And it's simply markets moving like this, or the inverted head and shoulders like this. Well, think about what happens. You're in an uptrend, for example, and you rally and you make a peak and you pull back. And you make another peak, the second peak, which is the head, those are your shoulders, and you pull back again, but the third peak loses a bit of momentum. Well, that's the first sign of trouble. Head and shoulders patterns are very common, they're very widely followed, and a lot of traders will pay attention to them. Why I like them so much. This is a downtrend, an inverted head and shoulders. You see we go a little lower, we pull back like you would expect, we go even lower. That's even better for the sellers. But then the third time, we don't continue the downward pressure. So what invariably happens is that a little time goes by and those traders start to become a bit concerned, and there's a neckline there. And the reason the neckline's important is because it's the trigger for selling, because you're in an uptrend, you've got people who bought all the way up to here, all the way up to here, even to here. But once you get through this neckline, you're breaking lows on a lot of different groups of traders. You have trapped traders, if you will, and then you sell off. The head and shoulders has a built-in measuring stick. You just take the highest point of the pattern to the neckline and then extrapolate that down. Pretty straightforward. It just is a failure to continue to make an uptrend. They don't have to be straight up and down. They can be at angles as well. Instead of just straight. The ones that are straight like this are a little easier to spot though. But beyond that, there's really no difference. So I'll go ahead and mark out the head and shoulders on this chart. Mark out the neckline. So by the time you break down through here, you have all of these traders are trapped. what you do is you measure the height, like I had said earlier, and I'm going to eyeball this and say that we are looking at a bottom of 133, a top of 134 and 10 cents or so. So that's about $1.10. So on this breakdown, you're looking for a move about $1.10 lower, which would have been 132. You most certainly got that. There's also the inverted head and shoulders. So you can see, as a recap, we rallied again, we got a little exhausted and broke apart. The inverted head and shoulders, in this one, we've been moving lower on Intel on the 15-minute chart. You can see everybody's happy. Then all of a sudden, there's a bit of a problem. You can see that, let's see, 50 and 49, maybe 48.90. So that's $1.10 or so over here as well. Once you break above there, we do drop back down, but we eventually hit the target. Now the question is, where do you put stop losses? Well, the most obvious place to put a stop loss is behind the shoulder. And that's what most people will do, because by its very construction, it's going to be less than you're aiming for, because you're aiming for that distance, and this distance is lower. So although you would have had a bit of a scare here, your stop stayed in place and you continued to go higher, eventually collecting your profits. Hello and welcome back to the complete day trading course by Wealthy Education. In this video, I'm going to talk about dead cat bounces, how to trade them. There's also inverted dead cat bounce. So a dead cat bounce it's the idea is that you're on top of a building, you throw a cat off the top of the building, and it hits the ground and it bounces. And it heads right back down. The history of this, I'm not sure why they chose a cat, but that is the meaning of this. And essentially what that means is that even though it bounces, it doesn't necessarily mean that it's ready to turn around and rally. It's just simply a natural reaction. And then you continue back towards the ground. Gravity eventually takes over. Now, there's also such thing as an inverted dead cat bounce, which is the market rallying, pulling back, and going forward. It's traded the same way. It pretty much is the same thing. Now, dead cat bounce, typically when people will talk about it, they talk about it on longer term time frames. But in our situation as day traders, we do see them occasionally. And what we want to see is we want to see it happen over the course of a couple of days, because you really want momentum to pick up. So let's say you're looking at U.S. Steel. On the 15-minute charts, I've got pulled up. You get involved in this day, and something happens to really send the market into a frenzy. You can see this massive volume spike. You can see I'm zoomed out here. We have a lot of selling. That first day, the second day continues to sell, third day, etc. So eventually you get another gap down and you start to rally. And the idea is you want to sell the rally. So there's a couple different ways you can do this. You look for an area that perhaps was previous support or resistance. And in this case, let's say that on the longer term chart, $31, $31.50, 32, this whole area here had previously been resistance. We broke above it. We pull back. And on the longer term charts, it does in fact show that. So we break through this area, we come back, we retest it, and it's time to sell. So that's one way to look at it. But really, what we want to do is we want to stack the odds in our favor as much as we can. So what I like to do is on a gap down from the place that it happens, draw a fib and just simply wait. Now, there comes a point where you have to kind of use the confluence of factors. And in this case, like I said, there were support and resistance. There's an area here between 31 and 32 that attracted a lot of attention in the past. It's also a box between the 38.2 Fibonacci and the 50% Fibonacci retracement level. And you can see it was, in fact, a selling opportunity. So what you're doing is, as it rallies like this, you recognize that that was the recent high, but there's a lot of noise here. There's a lot of reasons to think that this could cause some trouble. Certainly the volume spiked here. So you're looking for a tradable pattern in this area, and you just simply wait until it appears. There's nothing magical about trading these things, because what happens is, somebody who is long of this stock and this happens to, they're trying to mitigate the damage. So they get trapped, they get out as quick as they can on a bounce, because it gives them the opportunity to perhaps recover some of those massive losses. In stock markets, these do happen occasionally. A lot of times it comes down to earnings, though. So, for example, this market here, this is Disney, and this is a little bit more liquid, so you won't see this as much. But clearly, so you can see that we gapped lower and we turned around and spiked higher. We rallied and we pulled back. So if you've missed this move, and it was nice volume, again, you could look for previous support and resistance. That's one factor to put in. And keep in mind that it's right here at about 150.50 or so. On this move, you could also do a fib. I draw that. So somewhere right in this area is what you're looking for, a supported buying opportunity. And we did, in fact, gap higher on this day, and that was a signal to go long. Now, like with all things technical analysis related, higher time frames certainly mean much more. When I pull up a daily chart, this is a dead cat bounce. You could draw, let's see, it started basically from here, so you could draw this, and, it started from here. You can draw this, and you can see the 61.8% Fibonacci retracement level offered resistance on the daily chart. And it is an area where we've seen traders go back and forth a couple of different times. So with that candle and then the gap lower, that was a clear trading signal. You got in at about 102.5. It got all the way down to 90. So it does work in all time frames. You clearly want it to line up with something else. I like support and resistance and fibs. It makes for a nice meeting of the two forces. You don't always get a re-entry. So that is a bit of a problem. Sometimes it's just a runaway market, and then you just trade it as a gap. But really, there's a little bit of an art. But like all things, you want a couple things to line up. This is probably one of the trickier ways to trade. That was the last video in Module 3. Thank you for entering the course. I hope you learned a lot, and happy trading.